One of the most favorable reasons to invest in real estate is its ability to provide downside protection. When you look at the other available opportunities that are out there, usually, if you're getting anywhere near the return profile that real estate has to offer, you'll likely be much closer to losing money if you're looking at non-real estate assets. Think about it. What are the most popular investment vehicles out there? Cash, bonds, stocks, private equity real estate. Then you have startups and hedge funds. When you think about it like that, you can see the stability of the cash and the bonds and that predictability of outcome, and the likelihood of losing money is obviously very low in those investments. On the other side of the scale, you have the stock market, which is notoriously volatile. Then you have startups, which maybe 1 out of 10 will be profitable. This is something really important to consider, because if you're feeling like you have analysis paralysis because of the fact that the market has dramatically increased since 2011 or so, and you're sitting in cash, you need to realize that effectively you are investing in cash. It's not only the loss of a potential opportunity, it's also the fact that you are investing. You are investing in a deteriorating asset class. You guys know I'm extremely cautious about the market cycle. It's a reoccurring theme on this program. But as a real estate investor, as a real estate entrepreneur, I have a fiduciary obligation to my investors to constantly be searching for deals and evaluating deals on a risk-adjusted basis. And there is certainly a risk to sitting in cash and watching your principal get deteriorated by inflation or missing out on great opportunities. So that's actually one of the main topics for today in this discussion. We have a really experienced operator that's going to talk about the benefits of staying invested and thinking about things in a longer term view, especially on a risk-adjusted basis. We're also going to talk about why our guest prefers investing in 200-unit multifamily assets as opposed to some of the smaller assets. And we're going to talk about a market which has come up several times on the program, which is Denver. We're going to talk about why our guest continues to be very bullish on the market, despite the fact that the market has experienced a massive run-up. Hey, also, just wanted to take a moment and thank you all for your support. We actually received more than 11,000 downloads last month, so I know you guys are all sharing the program and commenting. By the way, if you haven't yet commented on the show, make sure to do it. It makes a huge difference in the shareability of the program. If you don't know how to do it, click the podcast, scroll down to the very bottom, and then click write a review. Of course, make sure it's honest, but we do appreciate those 5-star reviews more than anything. Also, we are getting very, very close to ironing out a deal that I'm really, really excited about. You guys know I am very picky about who I work with and the types of investment vehicles that we work on. We'll probably do 3 deals in 2019 or so, but we're very, very close to putting something out. So if you're not already signed up for an account at ASIM Capital, make sure to do so. You can do so at www.asimcapital.com. Just click invest, create an account, and that way, as soon as this deal is launched, you'll have access to it. If it's not already up, it's not already up, but it's likely that it'll be up in the coming weeks. So you just want to make sure that you get that notification first, just in case it fills up too quickly. All right. Hope you enjoyed the episode. How's it going, everyone? Our guest for today is Josh Satin, who is a 2-time Division I college All-American baseball player who's drafted by the New York Mets. Josh played for 4 MLB seasons before retiring in 2016 and joining the Gelt team. As Director of Acquisitions, Josh is tasked with sourcing, underwriting, and analyzing all multifamily investments. He's helped Gelt acquire 8 assets totaling over 2,500 units, valued at close to $350 million. He's also been instrumental in helping Gelt enter into the mobile home park space by assisting in the acquisition of 8 parks, totaling about 1,000 spaces in the last 2 years. Josh, it is an honor to have you on. I am really looking forward to this conversation for a variety of reasons.
Hunter, the honor is mine. I'm a listener of your podcast, and I've listened to almost every episode, so to have me on, I'm very honored.
Hey, I appreciate the listenership, and it's definitely well-deserved in terms of, being a guest on the show. And I've seen your career's just changed your understanding of the space. It's just really, really exciting to watch that happen. And, again, I'm really, really excited about this conversation. So before we even jump into multifamily and the changing market dynamics and even maybe a little bit about mobile home parks, if you have time, let's talk about your background. I mean, obviously most people's bio doesn't start with 4 years with the Mets. So let's start with that. How did you get into baseball, first of all, and then how did you feel about that transition out of baseball, which I know is an uncertain part for a lot of athletes, into the multifamily sector? How did you manage to do that?
Yeah, well, I got really lucky with my transition. But to start, so I'm from LA. went to UC Berkeley on a baseball scholarship. I got drafted by the Mets in 2008, 8 years with them and another year with the Cincinnati Reds. And in 2011, which was my first year in the major leagues and my first year actually making money because minor leaguers are highly underpaid, which is a whole different conversation. I got some really good advice from a family member saying you should put some of your money into real estate. I had no idea what he was really talking about, but in 2011, I invested into a multifamily deal in Temecula, California. I invested $50,000. It was a lot of money for me at the time. I had no idea what I was getting myself into, but I trusted this guy, my uncle actually. And from there, the deal went amazing. We were able to refinance the loan after a year. I got all my money back in a year, and I was hooked.
Wow.
So I ended up doing, I think, around 10 syndications while I was playing ball. And I really fell in love with the industry, with what it could do for people. And for me, when I retired in 2016, 15, the passive income that I was getting from these investments really allowed me to live my life the way I was when I was still playing without any hesitation while I was looking for my next career. So to me, it was a no-brainer that I wanted to get into this industry and really do for other people what real estate was doing for me. So the group that I was investing with actually introduced me to Gelt in 2016. I met with Keith and we just hit it off right away. We both saw eye to eye. We both had the same kind of goals. And, from there, I've been here ever since. So it's been, I feel very fortunate to have met him, to have been able to hook up with Gelt, because I came in with very little knowledge of not only real estate, but how to work in a normal job. So
Sure.
It's been an unbelievable transition in the last 3 years or so. And I feel very fortunate to be where I'm at.
Yeah, it's interesting that you say that because, I similarly, out of college, basically started the company. So I don't have a lot of experience working in a quote job or a quote normal company either. But I can promise you that Gelt is no normal company. I mean, going from 0 to $1 billion in assets under management in less than 10 years is absolutely remarkable. And I am a huge fan of, both Keith and the other principal there and just the culture as a whole, which we could definitely talk about. But let's circle back there just because I want to highlight the fact that you started on the LP side. You started as a passive investor, learned the benefits of real estate, I guess, from experiencing what it's like to receive passive cash flow. And then how did your understanding really start to transition from being on that passive side to being on that active side? And are you still doing passive investing as well?
Yeah. So what I did when I retired, I reached out to anyone I knew in the entire LA area and beyond and sat down with them and said, what do you do for a living? And I'm talking accountants, lawyers, guys that own random businesses. And then I sat down with this gentleman that I had been investing with passively for the last 5 years. And I said, what do you actually do? And the other times I was talking to other folks about, whatever they were doing, it really was going in one ear, out the other. It was pretty boring to me. And I was like, there's no way I could imagine myself doing this. But real estate, the excitement, what goes into the day-to-day, it really resonated with me. And, I was on pins and needles, every word this guy was saying. So, to me, real estate is all about numbers and networking. So, math has always been my strong suit and networking is the most fun part of business. So to me, it was a no-brainer to try to get involved with this. And so, the transition's been interesting. From day one, I really, it's crazy to say because I had invested in 10 deals already, but I didn't really know what net operating income meant. I didn't know, much what anything was. So the guys here at Gelt really took me under their wings. I spent a good year basically just following our now COO, who's the director of acquisitions then, Jeff Harris. And he really, taught me from the ground up what everything was. We went on every tour together. I probably the first year toured 50 buildings, maybe even more than that. And, slowly the transition was I was going to take that role. And so it's been an exciting and fun transition to where, now I'm the one leading the show. So it's been, I really am fortunate that these guys had that faith in me and that they took the time to teach me how it really goes about.
Totally agree. And let's talk about Gelt then a little bit. So what is the current investment thesis over there? Obviously your focus is on multifamily. You have a mobile home park arm, but generally speaking, within the multifamily niche, where are you guys focused?
So we focus on 200 units and up in major secondary markets. Our biggest markets are Denver, Salt Lake, Portland, and Seattle. We made our name in Phoenix, but we exited Phoenix a couple of years ago, maybe a little too soon, but it allowed us to get into these other markets that have been really strong. So we look at low dense garden style buildings, within a 10-mile radius of a major MSA. We don't want to be downtown, but we want to have access to downtown. So those are the kind of demographics we look at. We want a nice value add story. We don't want to pump, we don't want to take properties down to the sticks and pump $25,000 per unit, but we want to do a nice $7,000 renovation to get a $150 rent bump. We think, with management, we can improve many assets of these properties. And, we're really trying to take an asset from, a nice C plus, B minus asset in a good B plus market to a B plus asset.
Okay. I really like that. And I appreciate the numbers there, especially you mentioned $7,000 per door, looking at $150 per month in rent bump. I totally see that as being a reasonable metric in terms of, that C-class product turning into a B-class product. This is something that has come up, I'm sure many, many more times for you than it has for me. And it's come up a lot for me. It's obviously really competitive right now in multifamily. There's a ton of liquidity in the market. The ability to raise capital is really significant. On a global perspective, the interest in U.S. real estate, going from my perspective at least, has never been higher. It's an incredibly desirable place to invest. And if you're going to invest, it's mostly in multifamily. So how are you able to identify these opportunities in the sector, given the fact that there are so many competitive people out there, especially in that 200 units or more space?
Yeah, I think that's a really good question. I think there's a couple of different things that we look at. First, I think the market is far more competitive when you're talking a purchase price of $15 to $30 million. I think there's so many groups out there, a lot of inexperienced groups too, that are popping up now that can raise $5 to $10 million and do a deal that's $15 to $30 million. We kind of play in the $60 to $100 million range, and definitely the competition is a little less, although we're kind of David versus some of the Goliaths that are in that realm. So
right.
We're give and take on what's more difficult and easier when you're going up against a Goliath like a Starwood, or when you're going up against 20 other Davids in the in the smaller range. But I think that key in at this time, especially in the cycle when it's so competitive, is finding assets in areas you believe in for the long term. I don't think you're going to win right now if you're going after assets with a plan of getting in, getting out in 2 years. So I think that it's finding those assets that you're willing to maybe bid up a little bit for, because you believe that this submarket in this market is going to be sustainable for the next 5, 10 plus years. And so that's kind of what we've done. Every deal that we look at in the markets that we're in follows a certain metric of, the cap rate, what the return is going to look like. They're all fairly similar. And so determining what you're going after is really a deal and a area that you believe is the most viable in that market for the long term.
Okay. I agree completely there. And there's a couple parts we can dive into. Just generally speaking, what does the financing look like? Because when it comes to that long-term outlook, if you have the investor base that's willing to hold for 10 years, that's going to help you a lot. But then the other partner you're bringing on is the financing component. So talk us through those details.
Yeah, so we always, and to a fault maybe even in the beginning, have taken out long-term fixed rate debt. So we're talking 10 to 12-year fixed rate debt, mostly Fannie Freddie. And, if you turn a property in 2 to 3 years and you want to sell, that can be a detriment at times.
Totally.
But I think it's a safety valve that you can use, when times are tough, because as long as you can hold the property through the tough times, you're going to come out on top if you give yourself 2, 3, 4 years on the backside. So for us, it's worth a little bit on the front end if things go perfectly to save ourselves in the back end. So our strategy's always been long-term fixed rate debt, and we've even sold early and probably take a haircut on price because we have to either prepay the loan or have people assume the loan that, the LTV might not be as favorable for them. But for us, I think in the long term, it's going to benefit us because we're not going to get caught in times when, short-term loans come due and, values might be suppressed.
So let's say, and I know that you guys did have some really early wins, especially in Phoenix, for example, which absolutely caught fire. Do you also have properties that you have had since those early days where you refinanced? And if you do refinance, well, actually, let me just ask you that. Have you guys refinanced assets as well?
So we won't refinance, but we'll take out supplemental loans. So an example of that, we have a deal in Denver that we bought for $72 million about 3.5 years ago, and the value skyrocketed. And we were able to take out a second loan. We can't refinance and take out the first loan because the prepayment penalty would be too high.
Right.
But we can pull out money with a supplemental loan. And we did that at a value of $105 million. And we're able to pull out over $20 million for our investors, which is almost the full equity raise. So that's where the upside is on these long-term fixed rate debts. You can take out these supplemental loans and you can really return all the cash flow. And if you can return all of it, obviously it's an infinite return after that. And we do that on assets that we think, like I mentioned, are viable for the long term. We definitely have bought assets that we don't see massive growth in the next 10 years. So in that scenario, we would sell them. We just sold a deal in Salt Lake City that we bought 3 years ago that, the value has skyrocketed, but it was not an asset and not a sub-market that we thought was that viable for the next 15 years. So like I said, we had to pay a couple $1 million prepayment penalty, which obviously comes straight out of our pocket, but the return was great and it's worth it for the downside protection.
Totally makes sense. When you do take out that secondary loan, are you able to also get institutional or agency debt, or is that from like a regional lender or a private lender? How does that typically work?
Yeah, it's from agency debt. It's the same lender that we use on the first loan. So
they're both the first and the second.
Yeah. So depending upon, the capital markets, it's usually about 75 basis points above what a normal 10-year fixed rate debt would be. But a lot of times, a lot of these first loans we took out were at 4%. And so now, if rates are 4.5, now you're all in at the second loan at 5.25, and maybe you're all in now at 4.5. It's still a favorable loan.
Right.
For the timing, and it allows you to pull out all that money.
So you mentioned Denver twice. I know that you guys are really bullish on there. It's something that's come up a lot in the program. I'm interested in it from a personal standpoint. I think the city's cool, but also it's spectacular in terms of it's ahistoric, but it's experiencing, right? The run up in prices is completely different than something that's experienced previously. What is the case that you make that this is the new normal for a city that historically has not been up in that San Francisco, Chicago, LA type of conversation in terms of affordability or lack thereof?
Yeah. I'm going to throw out some numbers and you're going to think, how does this guy know this? Well, we just are doing a deal in Denver and I built this offering memorandum with all these numbers. So all these numbers are in my head. So it's I usually don't know this kind of metrics off my head, but first, Denver predominantly in the past has been, middle America town. But, with the millennial, so first of all, the millennial growth in Denver has been astronomical. In 2017, the millennial population has grown 4 times the national average. So you'd ask, why is that? Well, it starts with 2 different things. The people that are getting priced out of San Francisco, not just the people, the companies that are moving out of San Francisco and even out of Seattle are going to Denver. And the millennials love Denver because it offers 2 different things that millennials like. They love to be outside and they want a strong downtown. And Denver is one of the only markets that offers that. 3 of our properties that we own are in a town called Lakewood. It's about 7 or 8 miles west of downtown Denver. And you can drive 5 minutes and go hiking, and you can drive 5 minutes and go downtown. There's not many markets that have the combination of that appeal to the millennial demographic. Population in Denver has grown 16% in the last 7 years. I mean, it's very hard to find another market, especially on the West Coast, where the metrics are that strong. Job growth, another 2.8%, which is double the national average. So for us, those are the key metrics that, not only everyone looks at, but it's looking at who is coming. It's not just looking at are people coming, but who is coming. And those are the millennials are the people that are coming and are going to be there for the long term. So that's what's appealing about Denver for the most part for right now. Also, the economy is so diverse. Obviously, there's a large tech sector, but, U.S. healthcare is huge. Aerospace is huge, broadcasting is huge, financial services is huge. All these areas have grown to where Denver's not just a tech market and it's not just one sector. There's so many different economic drivers that are making this market boom that it really gives us protection on the downside that, if one sector goes, it's not going to affect the market that much.
Totally. And definitely something that's taking place. It's obviously the tech sector is driving the ship, it seems, but the infrastructure is being built there to take on jobs of all shapes and sizes. So you really are getting that diverse economy. I start to get uncomfortable when, let's say, 25 or 30% of the employment is dominated by the tech sector or so.
I agree.
But to your point, it's a large city and you really just are still getting that disequilibrium in the sense that you can drive in LA, you can't drive 5 minutes. Ralph's is across the street from me. I can't drive there in 5 minutes for a variety of reasons. So, you still get the benefit there of without the density that comes along with population and traffic and stuff like that. So pretty fascinating. Let's
one more before we
get sure.
off. One other metric that I like to use that is a big driver for me in Denver is the rent to income ratio. So a lot of these Western markets that are growing tremendously, Seattle, LA, San Francisco, these, if you look at population and job growth, they're astronomical and they might even be better than Denver. But In San Francisco, people are paying 46% of their income in rent. In Los Angeles, people are paying close to 40% of their income in rent. In Denver, it's 26%. So for me, that means people are making a lot of money, but rents, even though they've raised tremendously, as you mentioned, they still haven't got to the point where they're competing, not even on a dollar amount, but on a dollar per income to all these other major West Coast markets that are growing as well. So for us, I truly believe Denver still has a lot of room to grow because people are making money and they're not paying as much in rent. And obviously that's a strong driver of why people are coming, but I think there still has a lot of room to catch up, to be a little behind these other major markets.
Yeah, agreed. And I think that that's actually a tailwind in the multifamily sector as a whole, because people used to make the case, listen, individuals, regardless of their age or net worth, are not going to pay 38% of their income to rent, just throwing the money away. Why don't they just buy a place? Right. Well, there's a lot of reasons that they won't buy a place. One of them is that they don't have a down payment. The other is that they may not want to own a place. So now you're seeing, San Francisco, almost 50% of income going to rent. This is not a good trend for the US as a whole, but it's a great trend if you're a multifamily investor, because where's the ceiling? Where's the true ceiling? It's unclear. Right. There just isn't supply coming online, and the mentality has shifted from people that all they want to do is own a property to all they want to do is be able to rent. And, it's something we're interested to play out. We have another, Neil Bawa is going to come on the show soon and talk about some of the metrics that he looks at. And I know that rent to income is a huge data point that he really focuses on. So, okay, that settles that. And I think you made the case very clearly for why there is even some room to run in Denver. And even if it doesn't, you're still looking for a long-term bet. And I think it's, in 10 years, I think Denver is still going to be in a really good position. So with that in mind, and the competitiveness of the asset class as a whole, just to put things in perspective, how active were you in 2018? How active do you think you'll be as a firm in 2019?
So we were very active in 2018, but successful not as much as usual. We had 2 acquisitions on the multifamily side in 2018. One was a 2-asset portfolio in Seattle, and one was a 2-asset portfolio in Texas. The one in Seattle, Seattle is still lagging behind LA and San Francisco as far as rent to income ratio. Obviously, the job population growth has been astronomical. It is very heavily weighted to tech, which can be an issue, as you mentioned. But in these little markets that we bought, and we bought in a market called Kent, Kent has seen the biggest upswing in rents the last couple of years, including the year that we bought it. And there's still so much room to grow, as they're not even close to where downtown is. And it's very accessible to downtown. As I mentioned before, betting on an asset in an area that you think will be viable for the long term, this submarket of Kent, they just built a railway station that takes people up to downtown in 20 minutes. And the station is actually walking distance from our property. So to me, that's a case where, all right, if you need to buy a 5.5 cap in Seattle, seems like a property that will be sustainable for the long term, because it's way more affordable than downtown, and it gives people easy access to downtown where they're not fighting the traffic that might take an hour to get there. So, that was kind of the reason we bought that deal. It was from a seller we've already bought 6 deals from. So we know how to take over from them. And it was really a very seamless transition for us. And it's been very good. We've owned it it'll be pushing on a year very, very closely. Other than that, it's been kind of a challenge. We were in the mix on a lot of deals that we weren't able to win for various reasons. But as you mentioned in the beginning of the call, there's just a lot of money that's chasing deals. So it's really sticking to your principles and making sure that things work for you and not, overbidding just to win a deal. But if you really believe in a deal, maybe pushing a little bit for that deal. We didn't really find that deal that we believed in. Every other deal had, a ward or two that would have been fine at a certain price, but at the price it traded for, it just wasn't for us. So we were fairly slow last year. But, in our past and this year, we look to do a deal a quarter, 3 to 5 large multifamily deals a year is kind of our goal every year. And we've been able to hit that other than last year. And we're starting strong, as we have a deal that we're closing in a couple weeks, as I mentioned, in Denver, that will start the year off right.
Got it. And this is one of the reasons that I wanted to have this call, because you guys are a real estate company. You purchase, manage, optimize, and sell real estate. And because of how competitive multifamily is, it makes people start to question what they're doing with their lives, right? If you're not buying real estate and you have a real estate company, you don't have a really great company. And by some people's perspective, just sitting on your hands. That's not at all what you guys are doing. And I wanted to hear kind of your thought process as you're working through deals, seeing deals that may have traded in the sevens, let's say 5 years ago, that are now trading in the fives, what's your perspective on staying active in the multifamily sector?
Yeah, it's a great question because it's really challenging. As you mentioned, we only make money if we buy deals. But, we've built a reputation, at least among our investors, as someone that is only buying deals that really benefit them. And so for us, that reputation goes away with one bad deal. So it's really, we're a steward of our investors' money. So it really, is necessary for us to make sure we're buying things for the right reasons. So if that means not buying something for 9 months, we're fortunate that we have a nice portfolio right now that can fund the company and still everyone can make a decent amount of money. But it's challenging, especially for me, because my job is to buy stuff. I am the director of acquisitions. My sole job is to buy real estate. And if we're not buying for 9 months, it could be looked at as I'm not doing my job. But I actually think I am doing my job because I'm making sure we're buying the right things. So, it's definitely a fine line. Making sure I'm still out there seeing everything is crucial. But if things don't work for various reasons, we have to make sure that we stand our ground and keep our principles and not buy something just to buy.
Certainly. And one of the things that you mentioned during that call we had offline was also the other available opportunities out there, especially when it comes to protection of capital. So I wanted to give you an opportunity to kind of expand on that portion as well, because I think the key here is that when it comes to losing money, if you were looking at real estate, stocks, bonds, mutual funds, ETFs, cryptocurrencies, speak to the likelihood of protection of capital in that real estate asset class as opposed to some of those other available opportunities that are out there.
Yeah. I personally have a decent amount of money in the market as well. And, I get questions from investors all the time. You think the market is high? What happens if there's a downturn? And for me, the situation is this. If you're invested heavily in the stock market, when the market drops, you could lose 20% on your money. Now, if you're patient and you let it come back, you'll be fine in the long term. But the one thing about the market that is different than from real estate is that it's liquid. And, people are human. And, people do panic at times when they're in the market and they see it tanking and then they pull out, and it might not be the right time to pull out, or they might miss the upswing. With real estate, what I like about real estate is, first, if you're low leverage with long-term fixed rate debt, it's pretty difficult to lose a property. Obviously things can happen and things can go way worse than you can imagine and think. But for the most part, as long as you are low leverage and have long-term debt, you're going to be okay and you can, withstand a downturn. So people are saying, well, what if if rents drop 10%? Okay, instead of getting 7-8% on your money, you'll get 3 or 4. How does that compare to the market when you're losing 15-20%? So for me, real estate, the liquidity that does not allow humans to make human errors benefits you, and the downside is a lot less than, the alternative in stocks and bonds and et cetera.
Yeah, agreed. I couldn't agree more. And I think that it's something that people should be considering, because when you're talking about losing principal, if the most conservative you can do is cash, then you will 100% lose principal functionally through inflation. And so you have to be mindful of that. And anybody in the world can generate an incredible return that'll rival the likes of Warren Buffett. If you wait 100 years and you wait for a really significant recession and you invest once and then you take all your money out 2 years, 3 years later, you can generate that massive 90% return or whatever. But the key is, who's going to win the long game? Who's going to win from the time that you're 30 to the time that you're 90? And the way to do that is to constantly be invested.
Correct.
And just to be really cautious about your leverage, which is really one of your underlying points there. Now, with the same conversation in terms of leverage has that discussion regarding the spread between interest rates and cap rates, which are really getting close to being really challenging to make that argument. At least in certain markets, obviously. So speak to what you're currently seeing in terms of that spread, and where do you think the opportunity currently is, and what spread are you looking for? Like, what's the minimum you're willing to go in a deal with a reasonable value add component?
Yeah, that's a really good question. And it's funny because even when I first started here, we were seeing 2-point spreads. And when you're at a 2-point spread, you have a lot of room for error. And when you have a value add on top of that, as you implement that 2-3 years later, you might be at a 3-4 point spread. Right now, you're lucky if you're getting a 1-point spread. which can be a little scary. On this deal we're doing in Denver, we are fortunate that rates are at a really optimal position for us. And we actually are getting close to a 1.5 spread. And that's just a function of the deal coming out while rates are high. And as the bidding process, rates dropped 50 basis points. But, if you can, anything above a 1 point spread that you think you can take in reasonable fashion to a 2.5 point spread with a value add proposition, I think is a viable option. It's when you start negatively leveraged or close to, maybe 25 to 50 basis points, and you have this big value add plan that you need to hit in order to get even a 1.5 to 2 point spread. That's where it kind of gets dicey and you can get in trouble. So for us, we definitely need to start above a 1 point spread with the opportunity to double or triple that through the next 3 or 4 years, and not through market growth, just through an actual value add plan.
Totally get it. And agreed again, because when you're looking at that spread, that's when you start to generate that 5, 6, 7, 8, 9, 10% cash flow, which are really hard to achieve otherwise.
Yep.
Talking about the other options out there. And again, with the conservative debt, the chance of loss of principal is really, really reduced. Now, I know that, when our conversation started, a big portion of what you anticipated doing over at Gelt was the mobile home park sector. And I'm obviously very bullish on the sector, and I have been and will continue to be until the play is completely eliminated, which actually I do want to talk to you about that as well. But walk us through what has changed, if anything, over at Gelt, because I know that the goals in terms of what you guys were anticipating buying have kind of changed since those early conversations we were having back in the day.
Yeah, it's been a fascinating space since we've gotten involved. We've kind of been dabbling in it for a long time, even before I got here. But once I got here, we really started to pick it up and buy, we bought 8 parks in a 2-year span. And the thesis was, the multifamily sector is getting competitive. Cash flows are starting maybe at 5, 6, 7%. And in the mobile home park space, not only is there downside protection through a downturn, but, you're cash flowing 9, 10, 11, 12% from the beginning with an opportunity to infill some homes or raise rents to increase that. It's completely changed in the last 2 years. I remember there's a big conference every year in Vegas. And the first time I went to the conference, it was a bunch of guys in cowboy boots and, your run-of-the-mill mom and pop guy that owned a park for 30 years and was going there, and meeting and greeting, and it was very casual. And in the last year, the demographic of these conferences completely changed, which is just a microcosm of the industry. It's all suits. It's Blackstone, it's, the Carlyle Group, it's all these major private equity players that have seen, some of the downside protection of the space, and in turn have drove cap rates way down to where, some of the yields are actually significantly less than in the multifamily sector without as much of the upside. You still have a lot of downside protection in comparison, but it's been kind of challenging because, if you're an investor and you have an opportunity to buy into a multifamily deal in Denver, that, cash flow is going to average 8.5%, and you can hit maybe a 15 IRR, 13 IRR over like a 7-year span. Why would you buy a mobile home park in, the outskirts of a tertiary market trading at a, mid 5 cap where the yields are less? It's hard to justify buying that. So the last year, we've really taken a back seat in the mobile home park sector, unfortunately, because I love the sector. I love the people in the sector. And these parks that we bought are really easy to manage. And it's been great for us, but we just haven't been able to find the kind of parks that we found in the beginning, with the cash flow that are double digits and, very little CapEx and whatnot. A lot of these parks now are, a lot of park owned homes, and they're still trading at a 5 cap. So it's hard to justify a purchase when, even though the multifamily sector is competitive, it's more appealing return wise.
Certainly, and also the amount of lenders in the space are much more significant, meaning the liquidity is much more significant, meaning if something goes wrong, you have a bigger buyer pool, et cetera. So that's definitely something that's noteworthy. So let me ask you this, and this is something we're going to be launching these Monday Minutes coming up soon, so I'm not sure when this will come out, but I've been thinking about, I guess, asking or contemplating whether or not the mobile home park business can expand and contract to the same extent that the other asset classes can because of the lack of development. So what I mean by that is that most asset classes, they have this natural cycle. There's a economic cycle, but then there's also the fact that when there's a lot of multifamily demand, it becomes more advantageous for people to develop assets. They develop the assets, they become overdeveloped. There's a couple of years it takes to absorb those additional units, and it's a natural cycle of things. This is not the case with the mobile home park business. So I wanted you to give your thoughts on, is it just mean that the play is done? Is it over? Is it just, the baby boomers have come and gone and now they've sold it to their grandkids or whatever, and that's the last time the property will be sold? Or what are your thoughts on kind of the nature of the lack of cyclicalness of the business as a whole?
Yeah, that's a good question. It's tough because the lack of supply and the lack of building in the mobile home park sector is a big reason why you should buy mobile home parks. But for me, at least, it's tough to get into a deal based on metrics that aren't easy to comprehend and easy to, put on paper. Really, mobile home parks right now, if you're buying a mobile home park at a 5 cap, and the thesis is, well, they're not building any, so over time rents have to go up because there's no other options. That's a decent thesis, but it's tough to make that pencil when, you're looking at a spreadsheet and it says, you're going to return 9% on someone's money all in on a 5-year hold.
Right.
So where in the multifamily side, they are building, but there's evidence that you can increase rents doing this. Tenants are there's just a huge tenant base of millennials coming in. So I think the mobile home park sector right now is a lot of speculation of what it will look like in a couple of years, in 5-10 years. And that has to do with the lack of supply that will never really come on board. But it's tough to justify buying something at a low yield and an all-time low cap rate. I mean, mobile home park cap rates right now are sitting between 5 and 6 for, your average run-of-the-mill park. Predominantly they've been in the 7, 8, 9, 10s. So it's tough to justify buying something at a cap rate that the industry's never seen because there's going to be no compression. Cap rates are only going to move up. So where's the upside come in there? It's tough. So that's kind of where I'm sitting. I think there will be a change at some point. It's kind of the flavor of the month right now. And I think as that kind of burns off, some of these parks might be able to trade at favorable cap rates. But for right now, it's very challenging.
Totally get it. And I've definitely seen a lot of that. If you're not really the most active firm in the United States, if you're not extremely active, you not get access to absolute first deals, it's challenging to find deals that make sense. Now, granted, I think it's great news to hear that you think that there will be an opportunity in the sector because I love the sector as a whole. So, we've got assets that we have a great basis in that will continue to optimize rents. And hopefully, as the cycle continues, more and more buyers will enter the space. And then hopefully some buyers will make some mistakes and then we'll buy some more assets. That's kind of the nature of how I anticipate it going forward.
Yeah. I mean, I still want to be invested in the sector, but I think as you mentioned, it takes the right operator that has access to deals that nobody else does. And I think where we are right now, multifamily is our number one priority. And so, we're kind of second, third tier. And if these deals are passed upon by the bigger operators, there's a reason why. And they're just less appealing. It's either price or it's either how the park is situated, where it's situated, et cetera. So, for us, even when we were getting some of these second, third opportunities before, they were really compelling. I think we're a little spoiled. The park that we did with you a couple of years ago, we thought that's how it was going to be. And I think we got spoiled because that's been probably our best investment in any sector. And we just haven't seen anything in the same stratosphere as that. So it's been a challenge when you get something that, you're hoping is the norm and it's so far from the norm that, living up to that is tough.
Well, that's the beauty of working with me. All of my deals are exactly like that one. So let's work together in the future. So before I let you go, though, one of the things I've been fascinated by with Gelt is I went to a couple of your events that you've had in your office, and it actually was really inspiring. I mean, you can accomplish some pretty remarkable things with a small team in the real estate sector. Gelt has certainly accomplished some pretty incredible things, and I wouldn't say you have a small team, but generally speaking, it's a lean and mean company. The culture there is really special. Everyone has a lot of respect for each other. The principals are looked up to. What are your thoughts on how this was able to be created? I talked to Keith about this last time he was on the show, but I want to hear your perspective. I mean, you obviously, you said you were scared about kind of transitioning outside of being an athlete, but I know that you had a lot of opportunities and you ended up going to Gelt for a good reason. What was compelling about that, and what's been interesting about the culture that maybe some of the listeners could replicate with their own firms?
Yeah, I mean, I think it starts with how we are treated and act like a family. From day one, everyone here made me feel like I was one of them. And even so that like when we go out, they always refer to all of us as partners. I'm not a partner, but for all intents and purposes, everyone else thinks I am, because when we're out and about, everyone that works here is referred to as a partner. And you kind of feel like you're a partner because you're not just an employee. You are tied into everything that goes on here. We all, talk about every decision that has to be made. If there's no like, I'm the boss, I make the decision. It is everyone makes decisions together. And I think that's our best attribute. And I think that's the way, we've been able to succeed. There's so many different divisions of a company. We have me, I'm the acquisitions guy. We have asset management. We have accounting. We have the guys at the top. But everyone is constantly working together for one goal. And we always bounce ideas. The asset management and myself, we're always talking about what they're seeing in markets. We meet every week together to, properties we own in different markets. What are the rents are, how are the renovations that we plan going? So when we look at other deals, I can know if it's actually viable, what we, planned on doing before. But I really think it's the family culture that we have. Our investor base, for the most part, is a expanded version of family and friends. I mean, we have 600 plus investors, but I would say if you ask most of them, they feel like they are our friends. And we've tried to create that not only in the culture of the company, but with our investor base. And so I think that's how we've been able to be successful, in that we're starting to be a large company that just feels like a family run company. And, obviously the partnership, they are all actually family, but, they've created a culture to where, guys like me feel like I am as well. When we have family functions, when my daughter turned 2, everyone here was at the birthday party, and there was only 30 people at the party and 10 of them were from here. So it's kind of the culture that they've built, in that, we all feel like we are in this together no matter what. And it's not I'm just a hired employee that is here to do something for the partnership.
Awesome. Well, I couldn't agree more. And I've seen that from top to bottom. So I appreciate you sharing that. Now, Josh, before we jump off, I want you to get the opportunity to share how listeners can reach out to you, learn more about Gelt and the company you guys have.
Yeah. If you want to learn more about Gelt, you can go to our website, geltinc.com. And if you want to contact me, my email is very simple. It's josh@geltinc.com, josh@geltinc.com. Happy to speak. I love talking real estate. It's funny. When I was a baseball player, all I wanted to do was talk about baseball. And I still do like talking about baseball. But now, this is my life, and I just enjoy talking, just like we are right now, about the day-to-day of what we do, because you never know what you can pick up from another person.
Totally agreed. And these conversations have obviously evolved over the years. So honestly, Josh, really pleasure having you on. Thanks again.
Thanks, Hunter. Really appreciate it.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.